Hi, joining us now is Jonathan Brummer, Financial Planning Support Consultant at ACSIS. Jonathan, welcome.
Thank you.
Essentially what the difference here is investing a lump sum using a phasing in approach, or just investing the whole lump sum at once. So it's a question of timing, and what are the different kinds of yields that you get?
Yes, I mean, I guess if you're an investor and you've got some money, let's say 100,000 Rand you want to put into the market, the question is, do you put it all in one go? Or do I say maybe for the next year I'll put in a little bit every month? The question is, which one of those two makes sense? And I think it comes down to a couple of arguments. For me, an important one is, what is the money in relation to your total portfolio? So if you're adding 5% to your portfolio, well, it really doesn't make a difference. You know, just put it all in. But as soon as you start dealing with larger amounts, it becomes potentially quite important. So we did some research and had a look at what would have happened in the past if you had done this. And the results seem to say that your phasing in is a risk reduction strategy, right? So you will give up some return, but you protect on the downside. And the optimal period seems to be somewhere between 6 and 12 months.
Before David comes in at you, I just want to ask, what do you do with the money that you're not putting in? And what is it sitting somewhere not earning interest, or are you actually tempted to spend it?
Well, I guess you shouldn't spend it, definitely not that. The idea is that it's somewhere safe, so it's potentially just earning a cash return while you're waiting to phase it in.
No, David, it makes sense. I think we all do that. We all employ it. You know, we don't. I don't do it on a phased basis, you know, every month. But if a client comes in, I normally go like 30, 30, 40 or so. Oh, sorry, 40, 40, kind of 20. Just phase it out, because you get what we're getting at the moment now. You know, you get a run in the market, pulls back for a few months and it just gives you a little bit of breathing space. So it does make sense, and it's the whole basis, I think, of the unit trust industry, Rand cost averaging, you know, where you do it phased in.
It's interesting though, if you look at it, it actually, on average, because markets are will increase on average, you're actually better off just putting it all in. So more than 60% of the time you would have been better off 12 months having just put the whole lump sum in, not phasing in. But people are interesting, you know, we've got emotions and we need to take account of those. And that's really where you get the big benefit.
In all fairness, when the market runs and you haven't put the money in, then why didn't you put all the money in straight away?
And then you start panicking and throwing the rest in too soon.
Exactly.
When it's too late.
Yes. Well, it's exactly what's happened now. You know, we've had quite a big pullback now in a lot of the mining shares, etc. And maybe if you are a mining bull in that, it's a nice time to say, hold on a sec, we've had the 5% correction or something like that. You know, let's have a look in and just adding to those shares at the moment.
I'm just interested in your research. I mean, I'm sure it's highly technical and complicated, but how far can you go with this kind of research, and how detailed is it?
Yeah, I mean, the questions you can ask are endless and the answers you can give are equally so. We had a look at equities going back to 1960, and we phased it in over different periods, so 1, 2, 3, up to 12 months. And then you can start looking at the returns over 12 months for that specific investment. And you start seeing that as you phase in for longer periods, you start limiting the downside. So instead of you having a minus 50, potentially you only have a minus 25. And that's the power of it. Problem is you give up some upsides. Instead of being able to have a plus 100 in a period, you only get plus 70. So you give up on the upside, but you gain some downside protection. And that's very important, you know, from a behavioral point of view. People often are afraid to get into the market, and you're better being in than being out. So if at least you get in when you get in slowly, that's better than sitting on the sidelines and not getting in at all. And I think that's where the real power of something like this
When you say
in.
people, I mean, this is clearly a thing where you need the experts and financial advisors to really help you and do the sums.
Yeah, I mean, proper advice is obviously always useful, but I've seen time and time again people don't listen to their advisors. They tend to do what they feel based on their emotions anyway. So perhaps if we can give individual investors some guidelines, that's good. And if they're going to use an advisor, even better.
What about that number 40%? That's something that comes up. It's another nice round number. We've had round numbers on the show tonight, nice and convenient, you know. When they say that such and such is going to cost 40.3% more, then you know they've done the sums. If they say 40%, it's a rough sum, you see. But that 40% of the time, the yield has been better. Now, I as an investor might say, well, how do I know you're going to get me in the 40% where it's going to work?
Yeah, no, what the numbers are saying is that of the periods that we tested, so obviously since 1960 there are however many 12-month periods, and of those, 40 of them, a lump sum would have been worse off and phasing in would have been better, but that means the other 60, the lump sum actually won. So you're more likely that the lump sum will win than the phasing in.
If you did it
but
at
you
any
take the
given
risk.
time.
If you did it at any given time. So, I mean, we don't know what's going to happen in the next 6 months or 12 months. We're just saying, on average, in the past, that's what would have
But
happened.
have you
as a
found
guideline.
reasonable predictors of when you should do what?
No.
I'd say from a practical point, I like to go in when you've had periods of weakness like we're seeing at the moment. Now, that's all depending on whether the market's in an upward phase, which I believe it is. So I don't do it as refined as Jonathan would do it. I prefer to actually say, hold on a sec, we've had a nice correction now, we've had the sell-off. Because if you really, probably, if you had to go and do your research, you'll find that there are some silly people, you know, they always buy at the top of the market, as we saw in the 2000s with all the kind of booms that we had with the IT boom and that, you know, people were buying
property
shares
in
at
the
100 Ps. Even in the construction boom that we've had now, people are still buying construction companies at these massive Ps, and likewise in the retail sector at the moment now, we're still buying at 25, 30 Ps, etc. So we don't buy it when they're 7 Ps and that. So, but that's a nice time. But it's, I can't argue with the research. You know, mine comes from the top of the head.
Research has shown, therefore it's true.
Yeah.
Is there a correlation in those percentages at all between the booms and the busts and the cycles?
Look, I mean, obviously when valuations are high, you have a bigger risk of markets dropping and then you would have wanted to phase in. But there isn't a strong enough correlation for us to say when Ps are at this level, you know, phase in, when they're not, don't. Markets just don't work that way. So if you think you're a competent market timer, you know, then you take the chance. I would argue
we're very good market timers.
I would argue it's not a great idea to try and time the market. So here's a simple rule, you know, phasing in does make sense, as I say, depending on certain set of circumstances, and you know, 6 to 12 months is probably a fair way to go about it.
So what sort of interest has been expressed in this? What is your market of people saying about it?
Well, we as ACSIS, we serve a network of independent financial planners. So it's particularly useful for them, especially when they've got clients saying, you know, should I do this? It gives them a nice framework to discuss this with their client and present a reasonable argument and get them to do the right thing.
They can say, research has shown.
Research has always shown.
I mean, I come back to your point before of, is it exactly 40? It's not exactly 40 yet.
40.83, then we believe you.
Well, it's different over different periods. So over, let's say, 1 or 2 months, you're roughly 40 or there. As you go longer, the chance of a lump sum winning, it's less and less and less. As you get to very long periods, US research says that if you phase in for 3 years, only 25% of the time your lump sum, the phasing in would have won. So that's why too long a period doesn't make sense at all. And too short a period, you might as well have just put the whole amount in. So that middle 6 to 12 is...
I'm not sure we quite clarified where the money goes when you don't put it in. If so, you're holding it back.
You keep it in a cash account.
I was going to say it makes it a huge admin error, you know, where you get a lump sum where a client wants in and you've got to manage these little bits all the time.
You know what, companies have the admin systems to do that. So,
I mean, just to...
yeah, I mean, their systems are set up to say, I will phase this.
You mean
in
like
over
a
the
stop
next
order,
6
it just
months.
happens?
Correct.
Okay.
Yeah.
And fees for this kind of thing? More fees than for a normal lump sum deposit?
No, I would hope not. There shouldn't be any difference there.
That's the
Not
next
at all.
question. What has research shown on that one?
I'll get back to you on the research on that one. No, companies are not going to, they shouldn't anyway, if they are, you know, run the other direction. No, they wouldn't be charging you more for that sort of service. Not at ACSIS anyway.
David, summing up on this issue?
That makes sense. I mean, it's something that we all apply. I think we always get, you know, when we make the decision to go into the market, everybody wants to do it now. And you want everything now, but you know, markets are volatile, and you know, to me, it's something that I apply, not as scientifically as Jonathan, but I think that it makes sense just to take your time about doing something.
I mean, intuitively, I think, as you say, you've been doing it. It makes sense to us as people, and I think this, you know, just gives you a bit more of a almost a scientific research basis for doing it.
As long as you say 40.83%, not 40%, got credibility. That was Jonathan Brummer, financial planning support consultant from ACSIS.